Guys, these are 3 stocks that are reporting earnings this week. Let's analyze them to see if they're potential stocks to buy even before the earnings get released. First stock, PayPal. Now, as you know, I own PayPal, and that's no reason to ever buy a stock. Never buy because somebody on the internet owns it, or even Warren Buffett owns it. We're trying to teach a process here that you can apply to your own investing. Now, PayPal reports today, and analysts are expecting $1.07 earnings per share and $7.88 billion in revenue. Now, the interesting part about PayPal, or as I like to call it, PayPizzle, is that it's a company that a lot of people have said is dying. But why is that? Well, this is the stock price. And as I say 1 billion times a day, news follows the stock price. What this means is where the stock price goes, the news will be reported to justify that movement. As it was going up, PayPal is amazing. As it's going down, PayPal sucks. Interestingly enough, I hear all the time PayPal is dying. Like I said, they're supposed to report $7.88 billion in revenue for the quarter. Let's see how that would compare to the previous quarter. They did $7.42 billion in the same quarter last year. Is it massive growth? Not at all. But guess what? Is this a dying company? Doesn't look like it to me. Look quarter to quarter here, comparing past quarters. 6.85, 7.42. 7.38, 8.03, 7.04, 7.7, 7.29, 7.89. I don't know if you guys are aware or not, but dying usually means it's getting smaller. Now, are there issues with PayPal? Yes. One of the benefits they have is they have Venmo. And the number of active accounts has decreased, but they're already seeing a slowdown in that. But the transactions per account has increased. The transaction dollars per account have increased. So you're looking at this saying, again, what is the emphasis here? Is the emphasis here that we just don't like where the stock has gone? Remember, there's a lot of reasons to not buy any stock. But whenever I see a stock go from an all-time high of 310 to a 52-week low, about a year ago, of $50 per share, it's got to at least pique your interest. Why? Because to lose 85% of its value or more in a matter of 2 years at that point, that's pretty interesting to me. Now, let's look at the story that the 8 pillars are telling. So if you look right here, there's one X right here, and that's the 5-year PE. But interestingly enough, the 5-year price to free cash flow is actually way better. This means that their free cash flow is reported higher than their net income. And we'll see that right here on the data right below. Their 5-year average free cash flow is $4.84 billion, while reporting net income, 5-year net income of $3.6 billion. I love it when a company reports a higher free cash flow than net income, because it's easier to manipulate this net income number than the free cash flow number. Another nice little metric here, gross margin of 45%. That's pretty healthy. So what this means is every extra dollar they bring in revenue, 45 cents of that is going to go to pay the overhead, taxes, and go to that bottom line. With a bottom line margin pretty consistent around 14%. But again, this is based on net income, not on free cash flow. So their free cash flow is actually significantly higher than this profit margin, which I absolutely love. Okay, 5-year ROIC, nothing to write home about. Buying back shares. I like the fact they're buying back shares as the stock has fallen. That's really, really important. We don't want to just blindly buy back shares. Now look at this. Revenue growth, $11.8 billion, led to $2.4 billion in free cash flow growth and $1.86 billion in net income growth. So again, more free cash flow than net income. This is stuff we absolutely love. And if they can keep doing that, remember, cash flow is the lifeblood of the business here. This is the kind of stuff we want to focus on. Now, guys, remember, it's not just about the numbers, it's about the story, and then how we put the story and the numbers together. PayPal has been known for a really long time. It was founded by the guys that were Elon Musk, Peter Thiel, and those guys, and it was part of eBay for a long time and then split off. Recently, they've had new management change. And of course, whenever there's new management change, there's going to be a lot more excitement about the future prospects. But I think this one's actually warranted. So previous to this new management taking over, a lot of people had believed that the company was mismanaged because of a lack of focus. Now, this new management is purely focused on profitable growth, branding their checkout via PayPal, and focusing on building out Venmo and making it bigger. The last team was really focused on making this some sort of super app, similar to WeChat in China. This new company this new management team is focusing on trying to make what's called Fastlane, which basically integrates out like Braintree, and customers can simply enter their email address. All their information is going to be populated and ready to check out. Now, here's another interesting part. I mentioned before about the company having this perception that it's a dying business. But here's something interesting. Outside of Amazon, it has the fastest US e-commerce growth for any company. Outside of Amazon, PayPal has over 35 million merchants integrated to use their checkout, and it's a payment option for over 80% of all US e-commerce merchants. Now remember, story, numbers, putting them together. So we saw the numbers, pretty good. The story sounds pretty good, but of course we have this perception of story. But at the end of the day, every investment is the present value of all future cash flow. So in order to determine what kind of return we're going to make, we've got to estimate what those future cash flows are, and it'll bring it back today. This is exactly why we use our stock analyzer tool. But before we get there, let's see what analysts think about the earnings per share growth for PayPal. $4.50 per share this year, going to $6.91 here in the next 3 or 4 years. So pretty decent growth. It's a little over the board, all across the board here. But look at this dying business revenue growth here. Dying business, 7.8%, 7.8, 7.5, 8, 10% revenue growth. So much for dying, I guess. Now, again, anything can happen here, but this doesn't look like a dying business to me. I'm hoping it's a misunderstood business and a business that people are bailing on because the stock prices fall. So what is the right price to pay for PayPal? Let's go pull up the last time I did it in our stock analyzer tool. Just back in June. Oh, look, I got points again for using my software. Years of analysis. Guys, started with a 10-year analysis like I usually do. Now remember, I love the reputation that value investors have. They don't care about growth. The very first line, revenue growth. And remember, I'm going to put low, middle, and high assumptions here because we don't know the future. We have no idea what's going to happen. So we have to make conservative and more aggressive assumptions and somewhere in the middle. And I'm doing it for all of these metrics down the way. And this is why, guys, if you have the software, it's really important to be able to do this to understand where you guys are in the company. So what were my assumptions in this company? I did 4, 7, and 10% revenue growth, okay? I did 12.5, 14.5, and 16.5 on profit margin. But remember, the free cash flow margin was bigger. So I'm really going to focus on free cash flow here. I did 16, 20, and 24%. And then for my PE, now guys, I actually went a little lower on the low side of 14 because this area is getting a little more competitive. So I wanted to be a little bit more conservative here. And I did high side of 20 and middle of 17. And guys, if you're new to our channel, I did a 9% return. The historical compounded, going back to 1871, return on the market with dividends is about 9%. Okay, the average is about 10%. So if you put 9 or 10% in here, it gives you the intrinsic value for the business. What's the business if it were selling for a normal price in the market? But remember, if you're buying individual stocks, it's important that you put a higher return here than the market return, because then why not just buy the market? Buy a low-cost ETF. So if you want an individual company, you got to put a higher amount in here. But I'm showing you guys what my intrinsic value is. I hit the analyze button, boom. I've got a low price of 60 to 75, high price of 150 to 220, and guys, a middle price of 96 to 130. And here's what's interesting. Even though the stock is up from a low of $50, that's 66% growth from the low. You still have some, if my middle assumptions are true, and this actually works out, you have about a 15% return potential on your investment. So there's still room there for a company that's up 60% from its low in the last year. Stock number 2, Sprouts Farmers Market. They reported on Wednesday. Analysts are expecting 76 cents earnings per share and revenue of $1.87 billion. Guys, it's another company I own. This is a company that I'm a little aggravated about. I bought in the low mid 30s and now it's at $120 per share rather quickly. Look at this very quick rise in the stock. Now remember, just because the stock goes like this doesn't mean you should buy it. You need to sit there and analyze it. Say, is there still room? And guys, if you're the kind of person who got lucky and bought this company very, very low priced and it grows in value, you have to sit there and don't be afraid to pay a higher price for it if it's warranted. That's extremely important in investing. If the fundamentals have gotten better, and if you bought it at a great value before, like we just did in PayPal, if you bought it a year ago, you're up 60% of your investment. Don't get attached to that purchase price. It's all about, that's already done. What's important is where's the stock going? This company is growing like crazy. They have 400 plus stores. Their goal is to get to 12 to 1,300. So they still have 3x growth there. They got a new CEO in the last couple of years that came from Dollar Tree or Dollar General and did a really good job of focusing on per square foot revenue. Profit margin of 4% in the last 5 years, last year 4.5%. And that's really high. Go look at Kroger and all those other companies. Those are 1 or 2% profit margin businesses. So here's the 8 pillars on Sprouts Farmers Market. High 5-year PE, high 5-year price to free cash flow. You know what I love? They're pretty much exactly the same, which means their 5-year average free cash flow, $268 million versus $263 on net income. So very, very similar. Now their free cash flow last year wasn't so solid, but they're opening more stores and it takes time for those stores with the money invested to get into a profitable kind of revenue stream. What's interesting to me about Sprouts though, look at this, $12 billion market cap and the enterprise value of $14 billion. That's not much difference for a retail business. Usually I'd see a much bigger difference there. Now, when it comes to retail, Sprouts has avoided many of the major pitfalls that have crushed, from an operational standpoint, other competitors. Their goal is to do about 10% annual store growth per year. And the most important part for them is building out distribution. Because remember, the more distribution they have, the better they'll have products coming in, staying good for longer and being able to make more money on that. And their goal is to have a distribution center within 250 miles or less from all their stores. This also helps them because now it allows them to drop the number of miles on the road for their trucks by 4% while still opening 30 new stores. Now, this might not sound like a big deal, but their average store used to be 30,000 square feet. Now it's 27,000 square feet. 10% less square footage, 10% less rent, more efficient. And of course, Sprouts realizes that even though their customer has more than 74% of their customers shop in store, they still realize after COVID that they have to be very aware of the e-commerce growth. So they have partnered with DoorDash and the other places that can allow people to shop online. And most importantly for me on the Sprouts brand, they know their customers so well, they have their own Sprouts branded products, which has a much higher profit margin than any of the other products they sell. And that could really drive up the overall profit margin and gross margin for their store. Look at this gross margin, 37%. And it's going up and up and up as the percentage sales of their Sprouts brand keeps increasing. As that goes higher and higher, this could become 45% or more. If that becomes 45%, where does this go? So you have a couple things working to the tail for this company. You've got an increasing gross margin, which will drive profit margin, and they can still 3x the number of stores they have. We always talk about these multi-baggers. They need to have a long runway with a lot of good reinvestment opportunities. That's combined right here. But remember, before you go out there and go in your account and say, let me buy this, remember, you have to analyze it yourself and understand it. And second, you have to make sure you're paying a reasonable price for the company. And we will get into that shortly with the stock analyzer tool. Let's get into what the analysts think about all this growth potential. Here's what's interesting, and this is what baffles me. $3.40 per share to $3.47 per share in the next 4 years for EPS. Doesn't sound like a company that's growing its stores 10% a year and growing, and it has profit margins and gross margins increasing. I don't know about this. I'm very confused by all of this. Not going to lie to you. Now, I go look at the analyst estimates for some sort of guidance, but I look at this saying, where is this coming from? Is it coming from a lack of analysts? Probably. I have no idea why. But this ain't the best here for EPS growth. But then interestingly enough, look at this revenue growth. 9%, 9.5%, 9.9%, 5.5%, 5.3%. So I look at this thinking, okay, so they have great revenue growth. They have increasing margins, but that EPS growth was non-existent. But of course, analysts have their own bias and they have their own pressures from other people. And I'm not sitting there saying that you should only take good analyst estimates. I like going to analyst estimates to see where are things falling here. This is a great place to sit there and start asking questions. And if you're in our community, start talking about things. But let's go look at the stock analyzer tool, because of course, if we're right and the analysts are wrong, what's this company worth? So I did 6, 8, and 10% revenue growth. Because remember, you're going to get 3 or 4% revenue growth naturally because of costs increasing. And if you're increasing your stores by 10% a year, this is pretty conservative. But I put this 6, 8, and 10%. Remember our profit margin increasing? Last 10-year average, 3.7. 5 years, 4.07. 1 year, 4.5%. It is increasing as time goes on. Now, free cash flow is a different story, but remember, as they open 20 or 30 stores, that's eating up $70 to $100 million of their free cash flow every year just to open those stores. So that free cash flow number, I'm not as concerned about here, even though they've done a pretty good job in the last 10 and 5 years, keeping it very close to profit margin. And of course, our PE. Here's the issue. It's about looking 10 years from now. And I look at it saying, okay, in this business, their ROIC will probably be higher and higher, and they have a higher and higher margin than other companies in their industry. Does that deserve a premium? I think so. I put 16, 19, and 22 for both these multiples, and our 9% annual desired return. Hit the analyze button. So guys, remember, low price of 56, high price of 120, middle price of 83. So remember, what was a great buy at 32, a great investor knows that if you pay the wrong price, you're overpaying. So for me, even though I'm very happy with my position, and old Paul would have probably sold this saying, it's too overpriced, let me take some profit. New Paul says, you know what? Great company, growing their revenue, growing their profit. I'm just going to keep riding it out. Where's the stock going to go? I have no idea. But my goal is to own great companies at what I perceive to be great prices. And I think my basis is very good, and they can grow into this value very easily as long as I just let them keep operating the business. And as long as my thesis stays the same, I'm a happy guy. Now, obviously, I talk about having discussions about this company. This has been a very popular company in our community we've talked about. And if you've been to our website, you've probably seen that we are absolutely limiting the number of daily spots to our community and software. And for the reason for that is we're solely interested in having like-minded investors who can help each other out with the data, the analysis, and most importantly, the emotional part of investing. You look at a company like Sprouts, and we have people in our community who bought Sprouts $30 or even cheaper. Well, then the emotional reaction comes, do I sell it now? Remember, emotion isn't just about the downside. Emotion isn't just about, oh my God, the stock is falling. It's also about the upside. Remember, you gotta let your winners run. And the emotional part of sitting there and staying with a stock as it goes up is very important. Successful investing and a successful life is about surrounding yourself with people who are where you want to be. And our community has thousands of members who are exactly that. As the community has grown, it's become less about me and more about you and how I can make this life easier and more profitable for you. And my team and I use every aspect of the software on a daily basis. Whether it's running our retirement calculator, doing our stock analyzer for figuring out our stock investments, or more importantly, the real estate calculator. The real estate calculator, I always give this example. We recently bought a $22.5 million property using it. We're in contract on a $7.5 million property. And I used it recently to buy $4 million worth of lake houses for myself for investment. This is how you use these things. And guys, there was a member of our community who on a live stream recently said he used real estate calculator to make an extra, what was it, $180,000 or $300,000? I don't remember the exact number, but I'll show it to you right now on a real estate deal because he realized the value of it versus what his real estate agent said it was worth. If you're new to Everything Money, you might not know this, but I used to work on an Excel sheet. And the most common question I got, I had this Excel sheet for my stock analyzer tool was, how do I get that software? And at the time, it wasn't possible because it was expensive data, but it triggered a phenomenal idea. Why not just create this for those who are asking for it? So here we are, and the great news is we are working behind the scenes to make the software better every single day. So before we make the changes that are going to drive the price up, if you sign up today, not only do you get all the software data, tools, everything we've made so far, but you're locked into your pricing tier forever. You get them all right now at one great and easy deal. So if you're interested in sleeping better at night, making more money, then go to everythingmoney.com or click on the link in the description below and sign up before these changes occur. And I'm very confident it'll be one of the best investing decisions you've ever made. Now, stock number 3 is the company that has owned my brain for a long time, Amazon. They report on Thursday. Analysts are expecting $1.13 earnings per share and $157.3 billion in revenue for the quarter. But here's what's interesting about Amazon. Look at where the stock's been. And this company has crushed it. This is going back to 2020. And this company has absolutely crushed it since 2020. So this is a good learning experience for people who are new to the channel. Back in August of 2020, it hit a high of 175. We're currently at 190. 2020 did 386 billion. This last 12 months, it did 605 billion. That difference there is 218 billion on 386. So what is that? 65 to 70% more revenue. We have 65 or 70% more revenue than in 2020, yet the stock is pretty much flat. Why is that? Why is that? Guys, we don't know what's going to happen with stocks in the short run. But you have to look at this and you have to ask that question because we talk about this all the time. Don't look at stock price for are you right or wrong. What we want you to do is look at what you paid for the company and are the fundamentals getting better. Let's look at the 8 pillars here. Not as sexy as people would believe for a company like Amazon. Revenue growth, check. Income growth, check. Free cash flow growth, check. Something I don't like about this is the free cash flow is lower than the net income growth. However, let's go break down their free cash flow and see why that is. Guys, look at their capital expenditures. Let's go back to 18, 13 billion, 17 billion, 40, 61, 64, 53, and in the last 12 months, 60 billion. They have started pumping money into these distribution centers, the trucks, airplanes, everything they're doing to make life easier for you. Jeff Bezos has a great interview where he always says, people are always asking me, what's going to change in the next 10 years? My goal is to focus on what's not going to change in the next 10 years. People are always going to want faster and they're always going to want cheaper. And that's Amazon's goal. They're going to be a lower margin business, but the point is they're willing to go out there and make investments in other things. 20 years ago, maybe 18 years ago, they made a big investment in AWS. That is now a big driver of profit. It's their cloud computing. Now, a little bit more story. In 2022, 89% of US buyers said they'd rather buy a product in Amazon than anywhere else. Guys, they have 300 million active users. 197 million of them are monthly active users. Guys, I'm an hourly active user on Amazon. The other day, I needed to buy deodorant. I just go on Amazon, I buy it, and I think people made fun of me, like, why'd you buy deodorant? I'm like, because it beats going to the store. I don't want to go to the store. I'd rather do that. And they have 200 million Amazon Prime members. Guys, that alone is how many billions of dollars a year in revenue, tens of billions. And it's growing, which isn't even surprising considering the average Prime user spends $1,400 per year shopping on Amazon platforms. Since inception, Amazon stock has been one of the best performing stocks of all time. But remember, from 2000 peak to the low of the market, they dropped 96% from $113 a share to about $6 per share. But in that time, Jeff Bezos said, he looked at the fundamentals. He goes, but all our fundamentals are getting better. That's probably when he realized that you have to worry about the fundamentals and the market is going to do what it's going to do. Since the company's IPO'd, even with that 96% drop, it's returned 31.78% per year dating back to 1997. What that means is for every dollar you invested in the IPO, you returned $1,551. Which is a cumulative return over 26 years of 155%. Amazon is literally the ultimate disruptive company. Anytime they enter a new market, they take huge amounts of market share and crush competitors. For example, when Amazon bought Whole Foods, that day the market cap of all major US retailers fell by over $10 billion in one day. And because of the large number of users visiting the website, Amazon is an extremely powerful advertising business that will continue to scale. That's something that people haven't realized yet. They have rights to Thursday Night Football, and they understand that live sports is a great place for primetime ad placement, and folks will pay top dollar. So, what's Amazon worth today? That's a wonderful story. But again, we have to remember, story, numbers, we got to put them together. So let's go see what analysts are saying about Amazon. Guys, this is a multi-trillion-dollar company, and look at this EPS growth, 482 to 1055, 76%, 23%, 26%, 20%, 17.5%. Not gonna lie to you guys, I would have never thought that was possible for a company that did $600 billion a year in revenue. Let's look at their revenue growth. Still double digits, 11, 11, 11, 11, 10.5. Huge revenue growth, doing almost $1 trillion in revenue in 2028 on average by analysts. Big growth internationally, locally, everything. They have so much growth potential. So, what is the right price to pay for Amazon? This is why it's hard on Amazon. It's hard to value Amazon because what is the profit margin for Amazon? They've shown, look at this profit margin 10 years ago. In the last 10 years, 4% profit margin, 3.3% free cash flow. Last 5 years, 2.3% free cash flow, 4.7% profit margin. Now, 7 and 8%. Is it going to get better? I would imagine it would, but their gross margin is not very good. Their gross margin currently is 18.2%. But guess what? A lot better than it was before. So that's the hard part about companies, even a large company like this that reinvests in itself so much. They're putting money into this machine to make it bigger and bigger and bigger. But where is the profit going to end up? We don't know. My guess is a lot higher than it is today. So the question is, when you're doing your low, middle, and high, what assumptions do you make? Well, I did 4, 7, and 10% revenue growth. I did 7, 12, and 17% profit margin and free cash flow. And keep in mind, this low side was just achieved this year for the first time. That's how much upside I'm giving to Amazon here. 7, 12, and 17. PE. Guys, if it's the everything company, 20, 23, and 26. Absolutely. Give it to them. Absolutely. And finally, a 9% return. Hit the analyze button. The stock's currently at 190. A low price of 78. High price of 363. Middle price of 185. Guys, I don't know what the right price for it is, but I'm going to have it on my watch list to look at it at 150. But guess what? It's going to go higher from there. So guys, if you want to see the stocks to buy before the end of the year, watch our next video. Thank you very much for your time.